Hello and thank you for joining us for today's webinar. This session is being delivered as part of our Tourism Enterprise Development Programme. We've been working closely with industry over the last number of months to shape and roll out this programme and respond as best we all can to the unprecedented events of 2020 and the ongoing impact of COVID-19 on the industry. You can access a range of COVID-19 support materials as well as signing up for webinars and expert advice on tourismni.com and covid19.tourismni.com. We've initially prioritised financial support, including financial planning, setting financial targets, cost-based analysis and pricing, as these are areas that continue to be raised with us by the industry. We would encourage you to continue to feed in on priority areas. If you could complete the feedback form following today's webinar, we can continue to tailor the programme to your needs, or indeed at any time, just feedback through tourismni.com or covid19.tourismni.com. I hope you all found today's session useful and informative. Thank you.
Thank you very much, Rosemary. And just to introduce myself, my name is Feargal McCormack, and I'm the Managing Director of PKF-FPM Chartered Accountants. And the subject of our webinar today is working capital management for Northern Ireland tourism businesses. And the webinar is being delivered as part of Tourism Northern Ireland's new Tourism Enterprise Development Programme. And with regard to the slides, could I again highlight that hopefully the slides will act as an aide-memoir, and these will be available after the presentation, but I will not necessarily talk to each slide. In the unprecedented trading and economic crisis currently being faced by businesses operating in the Northern Ireland tourism sector as a result of the evolving COVID-19 crisis, the life support system for most businesses will be their ability to generate cash. Working capital plays the pivotal role in a business, similar in some regards to the role that the heart plays in the human body. The dynamic disruption to markets and sustained uncertainty, yes, has without doubt resulted in increasing pressure on tourism businesses and their liquidity and cash flows. Businesses with low cash reserves or unstable cash flows are especially vulnerable in the short term, based on various empirical studies on previous economic crises. And if you think about it, when cash is king, working capital is queen. Businesses with strong working capital management have proven to be less impacted and more resilient during challenging economic times. Yes, cash preservation is now critical, and the focus for us all should be on cash conservation and the cash flow cycle to unlock cash from the existing working capital cycle. Designed to help businesses operating within the Northern Ireland tourism industry, this webinar hopefully will provide practical advice and tips on how you can successfully manage working capital and the cash flow cycle within your business. At the outset, it is acknowledged that one-to-one mentoring may be available to enhance knowledge and understanding of specific elements of working capital and cash flow management. And we'll come back to that again towards the end of the presentation. The evolving coronavirus pandemic means that we are currently living and working in an unprecedented and extraordinary times. I've referred to that a few times in recent webinars. And for businesses operating in the Northern Ireland tourism sector, most of whom have experienced, if we think about it, a cessation or significant reduction in revenue through phases of non-trading, then trading, and again, non-trading at present, and hopefully trading shortly from the 27th of November. The reality is that there's no simple blueprint or roadmap to weather the current storm. However, it's particularly important for them to adjust operational behaviours and processes for working capital at pace. There is no doubt, albeit we're yet unsure when, but COVID-19 will end. But the reality from a business perspective is that we must plan for living with and post COVID-19. Given the current COVID-19 times, the way in which a business manages its working capital will determine whether it merely survives the crisis or indeed emerges from it as a winner with a proven sustainable business model. What we're really suggesting is that businesses must now put cash at the heart of operational and strategic decisions. Yes, there is a rapid shift in working capital patterns and working capital requirements, driven by both the disruption of supply and demand. The impact of COVID-19 is affecting and disrupting revenues, demand, supply chain, staff availability, and the day-to-day operations of businesses. And therefore, if you think about it, a business's demand for cash can come at unprecedented speeds in challenging times. Thus, in order to be resilient, a business must address key questions to understand its cash needs, and we're going to come back to that shortly. With the mixture of out-of-state visitors, market likely to take some time to come back to prior COVID-19 levels, reduction in leisure travel, multiple corporate travel bans, and a large volume of events, including weddings, conferences, staff, Christmas parties, etc., being cancelled or curtailed. It will be important for businesses to enhance operational performance by identifying any potential quick cash flow wins. In addition, the home market and staycations, as businesses reopen, must be given top priority for marketing strategies, with an emphasis, I would suggest initially, on the island of Ireland. There's no doubt a new business landscape is evolving, with expected changes in market and consumer behaviour and attitudes. We will all have to learn to do business in different ways. Yes, we will have to be agile and flexible. And as a result, we must focus relentlessly on the key drivers of cash and the key risks across our businesses. As highlighted in an earlier webinar, finance providers will also have adjusted their criteria to reflect the new economic challenges created by COVID-19. For example, I can tell you I've already had this experience a number of times. They are likely to pay particular attention to the ability of the business to fund its working capital requirements, and may wish to review a tourism business's policy and, for example, it's the risks associated with that particular business, re-advance deposits and vouchers. Re-advance deposits and vouchers, this is money you will have received in advance for an event in the future, or for some service you're going to provide in the future. They'll want to know perhaps, is your business or has your business ring-fenced any funds from these advanced deposits or indeed vouchers into a separate bank account, and reflect them, and have you reflected them as deferred income in your accounts because you haven't yet earned them, you haven't yet provided the service for which you've been paid for. Now, the truth is that they will wish to assess risk that your business may not be able to repay these amounts back to the customer if they come demanding them, assuming they're in a legal position to demand them back. And we realize there's different rules there depending on cancellations and who cancels, etc., etc. But whatever, the fact is very simple. Have you applied the matching principle? And if you haven't, the big fear from banks or other financial institutions is, though they mightn't be just so blunt to tell you, but the reason they're asking you the question is because they want to know, have you used money or cash you've received for deposits or vouchers to actually fund your ongoing working capital requirement? There's no doubt about it. Another area that we'll cover briefly during the course of the seminar is COVID-19 supports and unsecured loan assistance. I'm sure you all know that has been changing quite a lot in recent days. And again, we'll try and keep you up to date with that. In terms of the webinar outputs, what we hope to achieve is that by the end of the webinar, you'll have a greater understanding of working capital and cash flow management, of cash conservation and the need for a high-level review of working capital, the three core elements of the working capital cycle, the cash flow cycle, COVID-19 supports, as we already referred to, and unsecured loan assistance, which has been available for some time. Cash flow forecasting we'll come back to again, but again, just more in terms of awareness of the issues as opposed to purely going through the detailed calculation of a cash flow forecast. And ultimately, hopefully, you'll leave this seminar with some practical tips for working capital management. So in terms of overview, what is working capital? Well, working capital is the capital of a business which is used in its day-to-day trading operations, and in very simple terms is calculated as its current assets minus its current liabilities. And working capital management refers to the business's managerial accounting strategy designed to monitor and utilize the two components of working capital, as we already said, current assets and current liabilities, to ensure the most financially efficient operation of the business. Now, it's fair to say the ultimate goal is to have adequate cash flow to fund operations and also to ensure the most productive use of your cash and indeed your overall business resources. Improving the way you manage your working capital will make your business more resilient to economic uncertainty and is a practical and cost-effective way to fund growth and the business's profitability. And believe it or not, we'll cover this in a case study later on in the webinar. It's fair to say also that practical strategies to improve working capital, including managing your customers and clients, stock and work in progress, suppliers and overheads, also has a great impact on the effectiveness of your working capital management. And finally, you should also be conscious of options such as sales credit insurance, which we're going to cover in a case study later on, fee finance, invoice discounting, leasing, asset-backed finance, effective tax and VAT planning, because all of these may have a very positive role to play in smart working capital management, depending again on the individual circumstances of your business. So we've already said 3 or 4 times that working capital is current assets minus current liabilities. So what do we mean by current assets? Well, what we mean is, and we'll share some examples in a second, assets held for a short period of time, normally, to be honest with you, less than a year. And assets that are expected, not only expected, but can be converted into cash within 1 year. And then what do we mean on the opposite side of the equation by current liabilities? Well, what we mean is short-term obligations. That is, debts to outside parties which must be paid and are due within 1 year. So, examples of current assets would be trade debtors, for example, the amount you're owed in receivables from customers you have supplied sales to on a credit basis. They'd also include, for example, prepaid expenses. For example, if you get a rent bill, if your year ends March and you get a rent bill for 6 months, well, instead of putting the entire 6 months into your accounts, you'd only put 1 month in, and 5 months of the bill would be reflected as a prepaid expense because you haven't yet got the benefit of the rent, and therefore it's an asset. That can come across quite regularly, whether it be in rates or rent, insurance, etc. Another current asset is actually stock. Stock, believe it or not, both in the form of it could be really anything, but certainly food and drink, and if you're a manufacturer within the tourism sector, the actual products you make, it's products or goods that are held for sale to be used in the value-added process that you provide. It's also, to be honest with you, and particularly in a service business, it's work in progress. It's the value of work which you're currently ongoing doing, but you haven't yet got to the stage you can raise an invoice. But it will ultimately contribute to an invoice being raised. And finally, it's bank and cash balances. Now, in terms of current liabilities, examples of them would be trade creditors. That's basically the amount you owe to your suppliers. And generally, they'll be paid in accordance with the credit terms you've agreed with your suppliers. It could be your taxes, your POE, your NIC, your income tax, your corporation tax. Your bank overdraft certainly is a current liability, because you'll find a bank overdraft is normally repayable on demand. Now, bank loans, very important. If the bank loan is for longer than 1 year, the only element that should appear in current liabilities is the element of that loan which is due for payment within 12 months. It actually is rather stupid and very much to your disadvantage if you put the entire balance in a 5-year loan as a current liability, because it could even suggest your business may be insolvent when it's actually not. And finally, it could again be lease and HP creditors that are due within 1 year. So if they're due, say, over 3 years, you put the element that's within 1 year within current liabilities. And similar to a loan, the element that's due beyond 1 year is reflected in what's called your long-term liabilities. Liabilities due after 1 year. So hopefully, having explained what working capital is, then we maybe address why is working capital management so essential. Well, look, if you even think of the current COVID-19 crisis and the disruption, it has caused to cash flow, particularly as a result of a decline in current or future sales, issues getting paid in respect of credit sales, maybe customers not being in a position to pay you anymore, the impact on the opposite side in terms of suppliers' credit to you, increasing costs for certain materials due to perhaps supply issues, increasing costs to facilitate social distancing operations within your business to meet current public health guidelines, focused attention without doubt. I don't think, certainly in my experience dealing with banks, I've never seen them so fixated now on advanced, on the whole area of deposits and vouchers. Hardly ever come up in the past. Delays definitely in receiving grants or supports. Stock holdings and foreign exchange rates volatility. These have all been factors in the last couple of weeks, months, that have actually probably affected most tourism businesses, and they're all working capital. Now, I said earlier that it was important to understand your working capital needs, and in that context, I think there's probably, there's probably 3 key questions to ask yourself. Is your current cash reporting capable of providing the working capital and cash insight you need at the right level of detail and at the right speed? So it's your management information systems. Secondly, what areas of your supply chain or revenue generation streams have been most impacted by the current crisis? And thirdly, what are your short-term, medium, and long-term cash needs? Now, those are key questions you really got to be asking yourself on a continual basis. And the truth is, in the tourism sector, trading crisis that we're currently experiencing due to COVID-19, businesses must move with pace, and they must recognize their ability to generate cash is ultimately, as I referred to in the opening slide, the life support system for businesses operating within the Northern Ireland tourism industry. Thus, if you pause and think about it, urgent priority then must be directed in this environment to aggressive cash conservation strategies, and also the implementation of a high-level review of strong liquidity and working capital management processes. And over the next few slides, I plan to further explore these 2 core issues. In terms of aggressive cash conservation strategies, I would suggest adopting a proactive, hands-on approach to cash management. For example, short-term cash flow reporting and forecasting using realistic assumptions, current consumer confidence, not consumer confidence 12 months ago, based on what you think is reasonable in terms of business recovery, based on actual bookings. And what you think is happening out there. Are some trends, maybe in some economies, that are a couple of weeks ahead of ours. The reality is, don't use last year's assumptions, because there is no possibility that you could currently make a reasonable case that the current business environment reflects what was happening 12 months ago. Without doubt, in the current environment, we're all trying to aggressively seek whatever support is available from the government via COVID-19 supports and unsecured loan assistance, and also obviously the likes of HMRC in terms of deferment of tax payments and VAT, etc. Yes, we need to negotiate with suppliers, and many of you will have already done this, to defer credit or defer payments, to extend credit or defer payments, to assess the adequacy of your current stock levels, and measures to ensure that customers pay you promptly. Yes, we must very quickly differentiate between discretionary and non-discretionary expenditure. And having carried out that urgent review, we must assess then what the business really needs now, as opposed to could possibly do without. We've got to enhance our control over purchases and the whole purchase order processing system. And again, just like discretionary and non-discretionary expenditure, we have to, in the current environment, divide our purchases and order processes into core and non-core. And then by lowering authorizing limits, lowering the limits upon which more senior people must be involved in the decision-making process. And then ultimately also reviewing the adequacy and the appropriateness of banking and other financial arrangements in the light of changing circumstances. Now, to be very honest, my experience is that most businesses are now at this stage. It was probably forced on them, but if they're not at this stage, I'd be amazed. In the current environment, most businesses have addressed aggressive cash conservation strategies. And then in terms of implementing a high-level review, well, obviously, we'll again cover these in more detail shortly, but you've got to understand the current position. You've got to create cash flow from the existing balance sheet, and we'll highlight why that's the most important, because that's the cheapest form of addressing and releasing funds into working capital. You've got to improve commercial and operational performance. You've got to have reliable management information. We've already hinted at that, and you must also address different scenarios and key performance indicators. And ultimately, in terms of working capital management, because what the brand and perception of your business is in the marketplace is fundamental in a period of great uncertainty. You've got to try and improve the perception of your business and utilize working capital management to do that. We've all also got to face the reality that we've got to be prepared to take tough decisions, because if you think about it, you may be facing challenging options now to preserve the long-term value and indeed survival, if not future, of your business. So if we look at these a wee bit more, in terms of understanding the current position, there's a need to basically find out, to try and assess what is the impact on your business as of now, what's happening just now, and the cost, and thereby try and ensure the cash consequences need is minimized. You've got to update your short and medium-term cash flow projections using realistic forecasts that are based on your actual bookings and your COVID-19 assumptions, as I said earlier, rather than prior year assumptions and comparisons. And finally, you will need to constantly keep under review and understand your funding position, whether it be with lenders, whether it be with shareholders, or indeed other options, including family helping you out. In terms of creating cash flow, releasing cash from your existing balance sheet, improve management of receivables, payables, stock and work in progress is without doubt the cheapest form of finance. And that is why during the course of this webinar, we focus so much on those three key areas of managing debtors and receivables, managing creditors and payables, and managing stock and work in progress. Now, it's fair to say we also touch on, if you're fortunate enough to have surplus cash, and what you might wish to do with that as well. Creating capacity in tough markets, creating investment capacity to meet evolving consumer behaviors, such as you will need to continue to explore what you need to invest in terms of new markets, new technology, online activity, marketing, social media, moving to reflect the changing behaviors of the marketplace, innovation and other transformations, and also not forgetting that there will be perhaps acquisition opportunities, if there aren't already, arising out of, unfortunately, some other people having problems. Could be your business's opportunity. And finally, deleveraging or deleveraging the business or improving the equity yield you receive from the business. This will be achieved through better working capital management. In terms of improving commercial and operational performance, well, you could, building on the proximity to customers and suppliers, getting close to both, keeping up good personal relationships, improving commercial thinking across all functions, not just the finance function, driving more effective processes, a demand for continuous improvement, and identifying and managing your risks quicker. Now, in terms of reliable management information and looking at different scenarios and KPIs, this is something actually we did in an earlier Tourism Northern Ireland seminar. You've got to have reliable management information, and it's fundamental, as is communication. You know what they say, garbage in, garbage out. You've got to also plan for different scenarios, since the impact of COVID-19 could be prolonged. So this is about doing sensitivity analysis. If this happened, if that happened, what would be the impact? Depending on the size of the organization, you should have a crisis management team, if it's not just you, to ensure there's a consistent approach across your organization. And without doubt, and again, we covered this in an earlier webinar, you've got to have clearly defined key performance indicators in order to make sure you're focusing your attention on the right drivers to improve your business. And in terms of improving the perception of your business, it is important to appreciate that strong liquidity and working capital management does improve the perception of your business. It demonstrates effective management, and without doubt, it acts as a morale to your staff, and it also improves the quality of the earnings of your business. Now, it's also fair to say, and excuse me 1 second just so I take a drink. It's also fair to say that there are internal and external factors that affect your working capital needs. In terms of internal factors, this is your own company size and growth rates, your own organizational structure, quality management information and management accounts, which we've talked about already, perhaps using real-time accounting software, which many of you are now using. The sophistication of your working capital management, that's an internal control, and borrowing and investing positions and activities and capacities. Equally, there are things outside your control. COVID-19 crisis, outside your control. The economy, outside your control. Government supports and interventions, outside your control, but it's important you avail of them. Banking services, outside your control. New technologies and new products, this is referring to those that are outside your control, but available to you, as opposed to the ones you develop internally yourself. Currency fluctuations, interest rates, and obviously a major uncertainty just at present is the impact that Brexit may have on your business. The bottom line is there are many influences on a business's need for working capital. So I hope I have set the scene for asking the next question. Why is cash flow management essential? Well, very simply, it helps you to navigate the way forward, to chart the way forward, certainly for the next 6 to 12 months. It helps to ensure the business is protected and able to recover, hopefully, quickly post the pandemic. It will ensure that you only borrow what you require and, big and, are able to service. You know, whatever about getting bounce back loans, coronavirus loan, business interruption loans, just remember they have to be paid back. So, you know, don't necessarily believe that a loan is a solution to everything. Be careful and realize that you have to look at your ability to be paid back in the future. Certainly, cash flow management helps honor commitments to suppliers and your employees. It assists in planning the right combination of various government-backed lending and support to avail of by your business. And it is useful, as we already said, to plan various scenarios in terms of your future planning, reflecting perhaps different lengths of periods and impacts of disruption on your business. I think we've said this regularly over the last few weeks in terms of our webinars, but I make no apology for repeating it again. Cash is not profit. And despite this being said so often, it's probably the most common mistake that you come across when you deal, as I do sadly quite often, with businesses who are in severe difficulties and even faced with going out of business. Profit is the difference between the total amount your business earns and all of its costs, usually assessed over a 1-year period or some other defined period. On the other hand, cash is the amount you have on hand to pay your debts. And I've regularly seen it, where businesses can be showing a good profit on their books and still be strapped by cash to cover their immediate debt. And remember, if you can't cover your immediate debt, you're forced out of business. And working capital management will impact upon cash flow. And in the past, we talked about the risk of overtrading. When a business expands, it's not just be happening now, but it will happen again shortly after the recovery starts to take off again. When a business expands too quickly without having the financial resources or the support for such a quick expansion. So you have to be careful to ensure that suitable sources of finance are obtained to avoid an overtrading problem. An overtrading problem is where you have rapid growth that can lead to business failure because you've utilized the wrong sources of finance to fund a working capital need. Now, I've used this example a few times, but again, I haven't found a better one in terms of very quickly highlighting what we mean by saying that cash is not profit. Here we have two businesses, Business A and Business B, and you can see that they're both basically doing sales of 100,000 each. They both have cost of sales of 80,000, so they have a gross profit of 20,000, or in this case, a gross profit of 20,000, and they have net assets by pure coincidence of 20,000 as well. So the two companies, in terms of financial performance, are exactly the same. So in terms of profitability, they're both the same. But let's look at the cash flow. If you look at Company A, they've actually received £40,000 from their trade sales, so they're still owed actually 60,000. And in terms of their creditors, their payments due to suppliers, they owed 80, but they've actually only paid 30, so they still owe 50. So the bottom line is a positive cash flow position here. They've got 40,000 in from debtors, and they've paid trade creditors 30,000. On the other hand, let's look at Company B. Company B, as you can see, has received £20,000 from its trade debtors, so it's still actually owed 80,000. So it's 80,000 receivables, but it actually has believed it's important to build up very good relationships and secure supply of product from its suppliers. It's actually paid 50,000 of the 80,000 it owes to suppliers, so it only now has 30,000 trade creditors. Same profitability, same net assets, both company, but a massive difference in cash flow. Company A has a positive balance of £10,000, where Company B, as you can see, has an overdraft of 30,000. So a movement of £40,000 in terms of cash flow in this very simple example to highlight what we're trying to do and say that please be very conscious that cash is not profit. So cash is the lifeblood of any business, and quality internal management information and cash flow forecasts are now a prerequisite. It's important that you try and move from focusing on what credit the banks will provide business to trying to manage your own business better to generate cash from within your own business. Yes, if possible, businesses should endeavor to be self-sufficient from a working capital or day-to-day operations perspective. Robust, rigorous, and regular reporting, the 4 R's, on cash flow definitely improve and enhance performance. Daily bank reconciliations, looking at your online bank balance perhaps, weekly and monthly forecasts. Self-discipline and good management, without doubt, techniques and behaviors will yield positive results by improving, believe it or not, by improving profitability, yes, reducing risks, but also by improving cash flow. And again, we'll show an example later of where smart, good working capital management can improve both profitability and cash flow. So, in very simple terms, having defined earlier what are current assets and current liabilities, it's fair to say there are 3 core elements of the working capital cycle which absorb cash requirements. And we're going to focus on these, first of all, individually, debtors and receivables, creditors and payables, and then stock and work in progress. And then, ultimately, we're also going to look at management of cash if you're fortunate to have any. So what is cash flow? Well, in very simple terms, cash flow, it's black and white. It's the cash on hand at the beginning of any period, the money you received, and less what you spent during the period, and the cash remaining at the end of the period. It's basically about speeding up. So smart cash flow, smart cash management in simple terms, is about speeding up your cash inflows and slowing down your cash outflows. And in reality, income and expenditure cash flows rarely coincide. But, and it's a really important but to understand, you must always be in a position to meet your scheduled payments. If you owe the bank, if you have a loan out with the bank and you owe them £1,000 next month, you can't ring up in normal circumstances. Maybe just at present you may get a deferral of payment. Period. But in normal circumstances, you can't ring up the bank and say, I'm sorry, I'm waiting on money coming in, I'll pay you when it comes in. Oh, sorry not. The bank's only taking a low interest return, even though you mightn't think that, because it's not a risk taker. It's expected to get its money whether or not you make a profit. And the truth is, what that really means is there can be times when you could simply not have enough ready cash to meet your commitments. So this all really comes back then to the cash flow cycle, where your inflows are from cash sales or accounts receivable, credit sales. They're from borrowing from a third party. They could be from other income as well. And they're from obviously shareholder or equity inputs. And that builds up your cash flow reservoir. And from that, then you pay out expenditure on stock and direct expenses and wages and work in progress reservice businesses. You also have to pay your fixed operating costs, and you've also got to pay your tax and if you're purchasing capital expenditure on plant and equipment. And then if you're paying dividends, or if you're a sole trader or partnership, which there are many in the tourism sector in Northern Ireland, you take out drawings. And equally unfortunately, if you're borrowing, you may have to pay interest. So that's the cash inflow and the cash outflow reflected in the cash flow cycle. And if you think about it, awareness of the various sources of cash flow problems are actually fundamental to working capital management. Collapse in the economy, insufficient funding, unplanned growth, poor credit control, international trading problems, and indeed undertrading, as we've talked, or overtrading, which we talked about previously. These all can have a big impact on cash flow. And really, as we've tried to say, the best way to improve your cash flow is your internal management and processes. And this is what we're now going to look at: your debtors and receivables, your management of creditors and payables, your management of stock, efficient management of assets, costs, trading patterns and volume, and then we'll touch briefly on cash flow forecasting. So as we have already said, three core elements to working capital cycle: debtors, creditors, and stock and work in progress. And at the outset, you can, if you want to try and estimate how your working capital requirements compare with what you're expecting or benchmarking it against other industries, you can work out a working capital percentage, which is trade debtors plus stock plus work in progress minus trade creditors over sales multiplied by 100 to get your working capital percentage. And then in terms of debtors and receivables, it's your trade debtors over your sales multiplied by 365, assuming your accounts are for a year, which gives you your average debtor days, the average period of days it takes to collect receivables from a credit sale. Now, there's a number of ways you can focus immediately and try and improve your debtors or your receivables manage. You can offer credit. You have to accept, first of all, that offering credit terms to customers may often be necessary in order to generate sales, but it can mean it takes several months, hopefully not, to receive those funds. Invoice discounting or factoring can provide an immediate cash flow benefit to grow the business rather than waiting for customers to make a payment. This is where a financial institution takes your debtor book as security and lends to you against your debtor book. Now, it's fair to say that early settlement discounts improve your cash flow by encouraging customers to pay you early or in time. It reduces your debtor days and improves cash flow to fund future growth. However, Early settlement discounts can also reduce margins due to the discounts offered. So it's important that sales and growth is sufficient to offset the loss of any income as a result of discounts offered. And you may remember in a previous seminar in this series, we covered the whole key area of gross profit and volume analysis, whereby if you reduced your price by X, as long as you knew your gross profit percentage, what extra sales would you have to generate in order to create the same gross profit. And similarly, in terms of simple sales operations, are sales invoices going out on a timely manner? For example, are you waiting until the end of the month? Are you posting the invoice immediately? Very important. Can the work be invoiced sooner? And that's a big area about work in progress. Or can you agree, if you think about it, which many of you do in the tourism sector, interim invoicing, whereby you may agree a deposit up front, you may agree another payment at a date coming up to the date of the actual event on the basis that you've incurred costs at that stage, re the event, etc. And are credit checks being carried out to safeguard you against a bad debt risk? You know, no doubt we've all experienced that frustration of being a busy fool, having worked perhaps day and night to deliver a sale, and then unfortunately not getting paid for it. Tragic. So in terms of debtors and receivables management, you can accelerate the monies due to you from debtors by following a few simple steps to try and reduce your debtor days. Again, agree terms of business, including payment terms in advance, and adhere to them. No good agreeing them if you don't then adhere to them. Very important. Establish limits for each category of customer and never allow exposure to slip beyond those limits. Credit checks. You can use credit agencies and company searches, bank references potentially for new customers. And maybe visit the customers or go and find out a little bit more about their business. Certainly if they represent a significant portion of your sales and you're overly dependent on that business, you need to make sure you know an awful lot more about that business if you're providing sales to them on a credit basis. Because once you give them the sale, unless you have a thing called a reservation of title, which isn't that common in the tourism sector, well then the product or service has left you, but you haven't yet got paid for it. You've incurred all the costs, but you haven't yet got paid. It's a higher risk. Definitely you should, without doubt, monitor debtors or outstanding from a customer before you make any further sales. This can be difficult now and again because you can have salespeople who's focused on sales or focused on turnover without thinking about cash flow management. Definitely maintaining regular contact with your customers is very important. You can consider charging interest in overdue accounts. You can certainly consider it, but whether you get it or not is another matter. Sales credit insurance is important in certain businesses, even within the tourism sector, and we'll come back to what that actually is. I referred briefly to reservation of title. It's unusual in the tourism sector, but it does apply to some businesses. And this is basically where you can put a clause in that says that you're entitled to the goods be returned to you in the event of them not being paid for. You can issue a request for payment. You sure can, no issue there. Send a letter out, or even create a 5-day letter, solicitor, or 7-day letter. But you also have to think here carefully. You've got to quantify the cost of you pursuing the debt. And if you don't mind me suggesting to you, before you go down that road, make sure whoever you're going to go after to get paid has the ability to pay you. And obviously you can go through the normal process of pursuing legal remedies. Now, we referred a couple of times already to sales credit insurance. So what is sales credit insurance? Well, it's taking out an insurance policy which protects against the non-payment of invoices issued on credit terms due to insolvency or default. And it helps your business, if you think about it, to protect balances due on outstanding invoices, services, or products you've already provided, to minimize the risk of bad debt, to reduce the administration burden with favorable bank terms and trade finance, hopefully as a result, to give confidence to your suppliers, to improve your cash flow, to explore new markets and improve competitiveness, increase profitability, and grow and trade with confidence, particularly suited to fast growth businesses. Now, I think, to be fair, one of the best things to do here is perhaps to basically use a case study just to show you the impact are the risk scenarios of having credit sales insurance and not. Credit sales insurance is normally be expressed as a small percentage of your total turnover. Let's say Company A and Company B, they both, unfortunately, circumstances given rise that they now have a £50,000 bad debt from a customer, same customer. In the case of Company A, they don't have sales credit insurance. So you think about it, tough luck. The customer has no money left, 100% loss of the £50,000 debt. And let's say, let's say for simplicity purposes, that a Company A has normally a net profit margin of 10%. Now, what that really means is, in order to recover that £50,000 bad debt they've lost, they will actually have to generate £500,000 in new turnover. Big pressure on cash flow and a risk to the business, particularly if the business is a small business. £50,000 could represent a very significant portion of their turnover. In case B, they basically had also the same £50,000 bad debt, but they took out sales credit insurance. And quite often, sales credit insurance policies provide an indemnity of 90% after basically 1 month, if you can prove the debtor cannot pay anymore, basically gone bust or whatever. And what that really means is then, in that case, after 1 month, you get £45,000 back on your sales insurance policy for the £50,000 bad debt you incurred. Now, so you can see massive difference. Case A, you get no money back. Case B, 45, and positive impact on your business and continuity. And the key here is, can you afford to include within the cost of your product or service sales credit insurance, and is it applicable to your particular type of product or service? And if it is, I think it's a no-brainer. So let's look at a few telltale signs. Excuse me. See, can the tea make any bigger impact than the thirst in the water was doing there? Hard to beat tea, even Warren-Point tea. So anyway, some of the telltale signs in terms of debtor management control to be on the lookout for. Look at or try and analyze any key contributing factors to an increase in the average number of days a debtor is taking to pay. And these could include weak credit judgment. You made a wrong judgment. You shouldn't have provided the scale of the credit sales you provided to this individual customer. Poor collection procedures. You're not following up your credit sales. You're not following up with up-to-date statements. You're not issuing your invoices on time. You're not enforcing the terms of your invoice. Customer dissatisfaction. You know, I think we have to accept quite often one of the reasons customers don't pay us is they're not happy with the service. So that's really important. We need to find out why they're not happy in order to get paid, but more importantly, to improve our service going forward, not only to that customer, but to other customers. Unfortunately, it could be down to an inability of the customer to pay. That's why debtor days is increasing. And that could give rise to a potential bad debt, similar to the case study we've just looked at. In terms of potential bad debt indicators, again, a few things to look out for. If a company is taking longer credit terms, or a customer without approval, followed by a number of small orders. So they're trying to be smart. They're taking out smaller orders to try and get off your radar screen. You won't maybe pick it up, but actually, ultimately, they're extending their credit to you. Post-dated checks. Oh, big warning. If somebody's giving you, why is somebody giving you, say, for example, maybe a rounded post-dated check as opposed to the specific amount that's owed on a particular invoice? Well, the reason they're doing that is they can't afford to pay your invoice. Post-dated checks, it's a major warning sign. It may be the only way you can get paid in the case of a high-risk debtor, but then if that's the case, you shouldn't then, once you get paid, extend credit again without totally reassessing the amount you should extend. Another thing to keep your eye out for is evidence of regular suppliers to different, regular switching to different suppliers. Believe it or not, if I spoke to our insolvency and restructuring department, one of the things they'll tell you if they ever take on a liquidation or even a CVA, a creditors voluntary arrangement, or an IVA, an individual voluntary arrangement, they'll tell you it's amazing how much the actual creditor actually use quite a few suppliers. So for example, if you provide platters to a business, food platters, and all of a sudden you notice they're up maybe at a couple of £100, and you keep your eye out and you notice they're going to a similar business to yours and they're getting their platter, and then they're going to a similar. So what they're actually doing is, rather than running up sales credit with you maybe of £2,000 or £3,000, they're running up smaller amounts with quite a larger number of potential suppliers. And believe it or not, you'd be amazed when a business goes under. You'll find that they have a number of similar suppliers of the same product, because what they've done is they've shopped around and extended their credit subtly from a whole lot of different suppliers. So be very confident, be very careful if there's evidence of regular switching to different suppliers. And the other thing is, if you take on a new customer and they're reluctant to give you a credit reference, think very carefully. And my honest advice is, don't take on the business. You're better not having the business than being and incurring costs than being you're better not having the business in the first place than being a busy fool, incurring the cost and all the effort and not getting paid. And I talked about earlier on, I think in the last slide, when I said about the post-dated checks, also be very careful of receiving round sum payments. It's another example of people not having the full amount to pay you. Oh, I'll give them £500 this month, give them £500 in 2 months' time. But they may owe you 322, maybe 9 times or something. But no, just keep the wolf away from the door. Give them £500 now, £500 again. If you do it yourself, you know in reality you're having cash flow difficulties. You're only trying to prolong the period of having to pay. Now, on the opposite side, if we look at trade creditors or payables, it's the money which your business owes to suppliers for products or services which you've purchased on credit from suppliers. And just like the way you can work out debtor days, you also have the ratio to work out creditor days, which is trade creditors over raw materials, direct costs of a particular raw material over all your raw materials, multiplied by 365. And this is then the average period it takes you, the average credit you get from a supplier before you have to pay. So some areas which you can work on in terms of improving your creditors or payments management control will be to ask yourself, who authorizes purchases? Is it tightly managed, or is it spread among too many people in your organization? Purchasing authority should be tightly controlled. Very important. Do you shop around for best value for money? Not the cheapest, by the way, best value for money. Do you know or do you appreciate the cost of the company carrying different types of stock? Do you have alternative sources of supply? If a supplier of goods or services let you down, can you charge them back the cost of the delay? Can you arrange to have deliverers of supplies staggered throughout the day? Do your suppliers have a supply and return policy, which means basically if you don't use it, you can return the product? Not always suitable, but can happen in some places. Can you pass on increases quickly from suppliers to your customers? Certainly make prompt payments only when you get discounts. If people's willing to, if you have cash and people's willing to offer you discounts, take it then in order to get the product cheaper. The possibility of consignment stock, which basically what that is, that's where people supply you stock, but if you don't use it, they'll take it back. Certainly in terms of Brexit, have you reviewed your supply chain strategy and policies, and will they impact upon the costs and the availability going forward? And we've already talked about reservation of title clauses. They're unusual in the tourism sector. They are there in 1 or 2 businesses, but they're more the extraordinary as opposed to the normal within the tourism sector. Then you move on to stock or inventory management control, and stock is your business's raw materials and finished goods and unfinished goods, which ultimately be sold in the future. And basically, in very simple terms, it's the direct cost of your materials over your average stock tells you how often your stock turns over in a year. You can do that for all your goods, or you can do it, say, for food separately, or drinks separately, or even for different types of food. And then if you want to get an overall global stock days similar to debtor days or creditor days, again, you put stock over direct costs, assuming the period is a year, and multiplied by 365. Now again, in terms of stock and inventory management, in order to ensure the right level of stock or work in progress, which we'll come to shortly, is being held, it's important to appreciate that too much stock could result in a higher risk of it becoming obsolete. It could result in theft, a higher risk of theft, obviously a higher risk of unnecessary storage costs, insurance premiums being higher, overstaffing, and unnecessary borrowings. And you think about the principal factors that need to be considered in determining the optimum stock level include projected sales levels, availability of raw material stock, and lead time that's required in terms of from supplier to get the product on your premises. And finally, obviously, the efficiency of distribution. Now, in terms of stock control procedures, definitely carrying out regular physical stock takes very important. And any of you who are in the food, the restaurant or the hotel business will know how regular stocks of food and stocks of drink, how important it is to managing your profitability, but also managing your stock flow to minimize as much as possible your stock holding costs. You should try and know that the number of times each major item of stock turns over in a year. And to be honest with you, yeah, consider selling off outdated or slow-moving merchandise, because unless it's very good vintage wine, I think you'll find that it often gets more difficult to sell if you keep it and it loses value. Now, as I said, there's exceptions, as I've used one there, but in most cases, that is the situation restock. In terms of stock control procedures, also I'm seeing within the tourism sector, some people considering having part of their product outsourced to some other manufacturer or producer. For example, I'm now aware of a number of cases where, say, for example, restaurants and hotels outsource maybe part of their service provision, whether it be to have their vegetables cut up, whether it be, for example, their desserts. Coffee shops quite often don't make some of their coffee cakes or some of their scones, they outsource it, and the same with some of their paninis, they outsource that to factories, and others they make. You got to review your security arrangements or requirements to ensure there's no stock going out the back door. That's where very close control of gross profit margin and physical stock takes helps that. Benchmark your average stock levels against other businesses and reduce stock to the most necessary items, and implement a just-in-time policy if you can. Now, in terms of work in progress management, this is where basically you are involved in producing something that takes a period of time to produce. And you got to review your existing work in progress practices to really ensure you keep it as efficient as possible, because you want to reduce the time scale of work in progress, because you want to endeavor work in progress to facilitate you to issue your invoices quicker. Basically, in terms of work in progress, always try and focus on contractor engagement terms with the customer, and try and convert work in progress either into interim, milestone invoices or final invoices, and ultimately getting paid for the work done as quick as possible. Now, in terms of the service business, to be fair, and there are a number of service businesses within the tourism sector, in terms of stock and work in progress management, a key ratio is your lockup, which basically is your debtors plus your work in progress. Debtors, and you put that over sales and multiply by 365. And you certainly want to try and minimize your lockup, because it can be very expensive, particularly in a service business where your major costs quite often are labor. Now, in terms of assets, and this was going back to our impact of the cash flow cycle earlier, we've got to go beyond working capital to plan for and execute cash management. We've got to ensure that we infuse a cash culture in every decision in the organization. We recognize that now may be the appropriate time, yes, to invest in technology, digitalization, or even acquisitions, as we talked about previously. But we also have got to put off any operational or capital expenditure not absolutely needed today, deferred. In terms of cost cutting, if we're being honest, we've got to make sure that the cuts are from the fat and not from the muscle of the business. Cost cutting, yes, is essential within any working capital strategy, but please do not impose arbitrary budget costs. Have a well-structured plan and go underneath the causes of the cost, as opposed to just saying 10% off everything. That's not a smart decision. You've got to certainly keep your overheads under constant review and have the courage to discontinue some costs if they're no longer consistent with the goals of your business. Currency management is another one. I'm not going into much detail today, but again, if you happen to be involved in receiving a fair bit of currency from different currencies, then there are techniques there that can enhance your management of foreign currency exposure. We've talked about COVID-19 supports a number of times. The truth is these are changing regularly in changing circumstances. For example, many of the tourism businesses currently are benefiting from the Northern Ireland Executive Localised Restriction Support Scheme, which came in effective from the 19th of October. The Coronavirus Job Retention Scheme, involving furloughed workers, as many of you know, has now been extended from the 31st of October to the 31st of March 2021. And the new job support scheme now, which was to come in on the 1st of November, is gone again. Equally gone, unfortunately, was the job retention scheme, which was for businesses that had kept, which had furloughed workers under the previous scheme and still were employing them next January or February, I think it was. They were going to get £1,000 per employee. That has now disappeared, but hopefully, once the furlough scheme finishes in March 2021, it may come back in again, perhaps June or July or something. And obviously there is all. Then you have the loan assistance, unsecured loan assistance, the bounce back loans, which I know many businesses in the tourism sector, the £50,000 have availed of, and larger businesses have tried to avail of the Corona Business Interruption Loan Scheme. Now, just again to give you an example of working capital management and how, as we talked about earlier, how within your own control, managing debtors, creditors, and stock, that basically you can really release cash from your balance sheet to fund further working capital. So this actually is a real case study, one we worked in about, I think, 2 years, basically the year ended January 2020. And so we looked at January 2019 and January 2020, and after January 2019, we sat down with a client, and between the two of us, we agreed KPIs. And if you look at the situation, in January 2019, by pure chance, just for simplicity purposes, this company achieved the same turnover in the year ending 31 January 2019 and 31 January 2020, £1 million turnover. Purchases were the same, 500,000 each. But let's look at this a bit more closely. In the year ending January 2019, before the policy was being implemented to try and reduce debtor days, the average debtor days of the business was 80 days. Thankfully, 12 months later, as a result of a lot of hard work, that was reduced from 80 days to 60 days, the average period it took to get paid by debtors. Similarly, at that stage, back in 2019, over the year ending 31 January 2019, the company on average received 75 days credit from its suppliers before they had to pay. Again, renegotiating of terms, they have managed over a 12-month period to be pushed out to 90 days. And similarly, in respect of stock and work in progress, really big improvement here. They really started to get into the whole purchasing process. Why were they purchasing? Why did they need to purchase? If they knew lead times and distribution could be a lot quicker, they changed suppliers here or there. But ultimately, they reduced their stock and work in progress days from 50 days. So that meant they were holding stock and work in progress on average 50 days, which would be very unusual in most tourism sector businesses. They reduced that to 30 days, which again, in businesses focusing on consumables like food, that would be very high. But again, it had a significant impact. So let's look at what their figures were. At the end of January 2019, their debtors were 219,178. Their creditors were 102,740, and their stock and work in progress was 68,483. So you add the debtors and stock and work in progress, and you take off creditors, and you finish up with net current assets of 184,932. So they required working capital finance to fund that. Then look 12 months later what they did. As we said already, they improved the period, they reduced the period, the average period it took them to get paid by debtors by really proactive policy. They got in and identified slow paying debtors, all that, and they got it down to an average of 60 days. They similarly pushed out the average period that they paid creditors from 75 to 90, and they reduced, as I said, their average stock days from 50 days to 30. The impact of that was that their working capital fell by £102,740. So basically, they had a cash flow saving, very significant, of £102,740. Now let's just think about that. If basically they were paying bank interest on average, bank about 4% on including charges, that basically meant not only did they improve their cash flow by 102,000, but they actually also improved their profitability by £4,110. And believe it or not, if their net profit was 5%, that would equate to incremental sales of having to secure incremental sales of just over 82,000. So a really great example of impacting the impact of implementing and putting in place an improved working capital management strategy. Now, we've talked regularly about the importance of cash flows at the start of the webinar, and to be honest with you, you could spend a full webinar purely on cash flow forecasting. But just again, to refresh with you the items that you need to give attention to in terms of cash flow forecasting. First of all, don't jump into it. Establish the baseline. Look at your opening balance sheet if possible as your opening balances for your cash flow. Then look at your get a copy of your current bank and loan statements at that date, and then also a copy of your debtors and your creditors listing. Because remember, you've got to make assumptions when you expect to get, when you're going to get paid from those debtors, and equally when you're going to pay your trade creditors. Then basically have a look at your in terms of your assumptions going forward. What are your outline priorities for future trading? What are the customer and the supplier relationships you believe you will need in order to ensure the future sustainability of your business? What are your business structures? What, in terms of your brand, where does your working capital management fit in? And then obviously the actual cash flow itself. So don't be afraid then to avail of all the support that's currently available, and discuss with accountants or other advisors the best combination of support that you can use in terms of funding your business. Having done that, then you start to create your actual cash flow, and you create it with cash inflows and outflows for each interval. If we assume you're forecasting over a week, then over a period of a week. If you're forecasting over a month, over a period of a month. And remember, your cash inflows include your operating cash inflows, your financing, which would be perhaps from a bank or from a HP company, leasing, and also putting back in profits, any profits you make in revenues, and in terms of costs, unfortunately, any costs you incur, that you pay, not incur, pay in terms of expenses, payments. And you include all the support available. And then basically, once you've done that, that's anybody can create figures. The most important thing then is basically to implement and monitor, review those figures, see how you can improve things. Look at your forecast, compare to actual forecasts, and constantly keep the thing. It's more the process is more important than the actual figures. Now again, I did this earlier in the year, this cash flow forecast for tourism business. And you can see what we were forecasting was a big dip initially. Wave 1 of coronavirus, May, June, July. We were forecasting, unfortunately, a considerable improvement and eventually positive cash flows from January 2021. But if you look at this graph here, you can see, unfortunately, we didn't include the second wave dip. So we were improving cash flow also in October and November. Tragically now, we'd have to amend this in terms of actual to show that businesses were closed. This particular business actually has been closed in October, so there'll be a further increase in the excess of outflows over inflows, which would ultimately have an effect. But again, I'm just trying to highlight to you a 12-month cash flow that's done on a monthly basis that was done for a tourism business that we were involved with. And this is what your actual cash flow looks like. I'm not going to bore you because really you have to go through the whole way it creates. But in very simple terms, you can see on the screen there, you look at your cash, it's purely, it's not income and it's not expenditure, it's receipts and payments. You look at basically sales, your very simple. You can see then your debtors opening balance is what you're getting paid from your opening debtors listing. And very good, they expect to be paid here within 2 months, so hopefully they got paid. And then you also had, they got coronavirus, they got furlough assistance, believe it or not, in June and July. Again, the payments, all your payments, including your VAT payments, your tax payments, any capital expenditure, loan repayments, all listed in your payments. And you can do it more sophisticated, believe me, a cash flow statement where you separate out operational cash flow and then total cash flow. But ultimately, you come down to a closing balance, which is basically your opening balance plus your cash inflows in a particular month, less your cash outflows give you your closing balance, which if you look at the illustration here, then becomes your opening balance for the next month. So in terms of some basic points about cash flow forecasting, you've got to decide the forecasting interval. Is it 1 week? Is it 1 month? Is it 1 year? In terms of cash flow, a year's a waste of time. So it definitely needs to be at the very most monthly, at the very shortest period. Sorry, the very longest period monthly, and perhaps even weekly. You've got to familiarize yourself. There's plenty of cash flow tools out there that can help you, including Excel. You've got to link your calculations and assumptions so you can amend them later to allow for scenario or sensitivity analysis. And you basically got to carefully evaluate every part of your business, whether it be the operating that we talked about, the financing, or indeed the investing in terms of maintenance and indeed, more importantly, capital expenditure going forward. And really what we're really saying is, in terms of the basics, divide your costs between, and we covered this in the previous webinar, between fixed, variable, and semi-variable. The difference being fixed or fixed for a period of time, variable, totally activity related, and semi-variable are basically costs which can vary over the period. They can move from fixed to variable or be partly split between variable and fixed. You've got to obviously very carefully consider the mechanics of working capital, which hopefully you now have a far greater understanding of from what we've done. And if appropriate, feel free to take professional help. Just a few practical tips may I suggest. Before you borrow, you should consider the following. In the short term, try first of all to encourage payment of debtors by offering cash discounts. Negotiate additional credit from suppliers. Reduce your raw materials or finished goods level and try and sell off slow moving stock, or even perhaps sell off assets that you're not currently using that are not the subject of any security. You could seek additional support from your shareholders or from family and friends, etc. You might even consider, unfortunately, deferring drawings, or indeed deferring drawings or cancelling them altogether, or indeed dividends. You could defer capital expenditures, we've covered already in the short term. You could lease rather than buy equipment. You get the benefit of the equipment, but you don't have to buy it all up front. And you could consider external funding. Some vital warning signs to pick out in terms of being wise, perhaps using hindsight from previous experiences. Falling sales or sales pipeline, obviously if you're ceased business altogether for a while, quite clear bad impact on cash flow, as would falling profit margins. Bad debts, have a look out if the number and the amount of them is increasing. The debtor profile, the profile of your debtors. Low stock turnover, all of a sudden stock isn't turning over as quick, or an increase in lockup days. Your staff are busy, but they're busy doing work in progress as opposed to converting work in progress into sales, into recoverable sales, and getting paid. Vital signs would be an inability to pay suppliers when basically they're on time, when their bill falls due for payment. Increasing bank fees and charges because you're making greater use of your bank, or you're going over your current your overdraft limit, and all of a sudden you get a whole lot of bank charges. Very costly. Obviously, if your VAT or your NIC or your POE liabilities are all building up, albeit thankfully one of the measures the government brought in was a potential to defer, as you know, some VAT and some tax liabilities payment for a while. as we've talked about before, increasing level of bad debt, difficulties in paying wages or indeed the director's salaries, and if you're finding you're having to communicate with the banks a whole lot more. So if you find yourself in the unfortunate position that you believe in advance you're going to have an inability to honour commitments, my strong advice would be to speak to creditors, banks, HMRC in advance. And if you're doing business in the south, it would be the revenue commissioners. Some of you are doing, I know, business across the border. Explore options, deferring or restructuring your current debt. Certainly, you could involve business advisors who think it can help you. Regular communication with your credit. Again, in my experience, if you talk to people in advance, quite often people are willing to understand and work into arrangements with you. Certainly, you'll have to show some pain yourself, deferred drawings or salaries. And as we've already said, the other points we've covered a few times, I think. You may wish to consider insolvency procedures. And if that's the case, you should talk to an insolvency practitioner. Certainly we have 3 in our own office, but this is to consider what your current position is in terms of meeting your liabilities if falls due and what options are open to you. And it's not all bad. There are a few good solutions that can be done, not only just restructuring, but you have also things like if you're a company, a CVA, which is a creditor's voluntary liquidation, or if you're an individual, a sole trader or a partnership, an IVA, an individual voluntary arrangement. Some lessons and advice, I'd say, probably from hindsight and sharing experiences from other examples, would be to carry out market research, get credit references. A lot of these things we covered before, but we're coming back to just highlight them. If you set credit terms in, honor them. Certainly, consider payments in advance. If you think your service or product is so good, encourage people to pay in advance. And we've already talked about sales credit insurance. Practical tips. If you're fortunate now to have surplus cash, some practical tips that you may think it's worth looking at would be to basically using that surplus cash to fund a disruption period. Use it to reduce financial leverage by reducing borrowings and debt commitments. You could also take advice on how best to ring-fence surplus cash to protect investment to use for future opportunities, and it may be better to extract it out of the business. To consider certainly risk-free investment opportunities, and perhaps it may be appropriate to talk to an independent financial advisor or indeed a tax advisor. I think the important thing to appreciate, however, is that excess cash reserves do enhance employee and shareholder confidence and the ability of the business to make a strategic move if an opportunity arises. Now, just before I conclude, I'd like to share with you a live case study because I think it highlights a number of significant points. It's a client we were involved with over a four-year period, a very deliberate, we're still involved with the client, but a very deliberate strategy because they were a fast-growing business that they had to somehow work. The only way they could continue, because they were a service business and their main cost was labor, the actually only way they could actually fund their anticipated growth was actually to significantly improve their working capital management. And this is really a business consultancy which is working in the tourism, hospitality and leisure sector. And basically what was agreed here was that immediately the target was to actually reduce lock-up days, basically debtor days in work in progress. And if you look at this example, and then we'll come back to it in a second, but what happened was in 2016, you can see the turnover of 4.2 million. And at that stage, it was an average taking them 115 days to get paid. In 2019, their turnover had increased dramatically to 7.6 million. However, they had reduced the average period it was taking them to get paid from 115 to 54 days. And we'll just look at that, what that meant. So what that actually meant, well, by the way, to do that, they dramatically changed their whole management information system, their dashboard. They allocated, they got very quickly into the whole process. They analyzed their debtors listing. They identified slow-moving debtors. They identified core debtors, and they started to put in place a whole relationship, which was actually more focused, believe it or not, on customer relationship management, dealing with customers, to first of all get the debtor days down. There was a whole greater emphasis on payment terms. Back in the first year, 2016, basically, you could only pay them by check. totally transformed that. You can now pay them by credit card, you can pay them by bank transfer, virtually any way you want to pay them. And they offer actually fee finance as well, whereby they could pay it out, our client could pay it up front, but the customer could pay it over 3, 6, or 9 months. So you can see they looked at every way to get paid cash in. And well, as the turnover grew in the last example, you can see by 55.6%. Annual debtor days fell by 46 days, 40%. And believe it or not, that released 836,000 extra cash flow into the business. And that allowed them to fund that additional growth, because your employees aren't willing to wait 2 and 3 months to get paid. They had to pay them. So rather than having to go out and they may not have even got it, source additional, say, external debt funding from a bank, they were actually able to fund this all internally. That's very impressive growth. And if you think about it, if you assume, say, a cost of capital, cost of interest, say, of 4%, including bank charges, then the cash flow saving of £836,000, that reduced the annual costs, so it improved profitability by 33,000. And equally, if you think about it, if the business had a 10% net profit, that would equate to £330,000 extra sales being generated by purely, to get the same profit, by purely improved management internally of their working capital procedures. In terms of work in progress, which is the other element of lockup, they went down to really, they reduced timesheets down from weekly to daily. They also reduced the unit of from actually 1 hour down to a quarter of an hour that you could record against time. And believe it or not, they reduced their work in progress. And if you go back to the slide a few slides ago, from 64 days to 28 days. And as a result, there was a potential cash flow saving of 654,000. So again, you can see at 4% interest, approximately £25,000 interest cost of capital saving, again highlighting that if you're going to generate that in terms of sales, that will require 250,000 extra sales. So dramatic change in working capital culture. Really, as a result, I can tell you, I know this business very well. There was a great improvement in staff morale. By the way, staff got bonuses. A lot of bonuses were related to cash receipts, and just simply a very happy client, but a very happy workforce, and believe it or not, a very happy customer base. And the reason that was, they did get underneath it and find that some of the reasons why customers weren't paying them was because they weren't happy with the service. So as they improved their service, they tied that into getting paid quicker. So what we're really saying here is that the working capital culture and processes for your organization must be inherent and interwoven throughout the entire operations of the business, recognizing that working capital problems are not just the domain of your finance department or your bookkeeper. Ensure that everyday conversations are used to drive continuous improvement in working capital performance. It's probably the one area within your own control that you can improve and have a dramatic impact on your cash flow, but also, in my view, as we highlighted in a few of those examples, it's no coincidence. By improving cash flow, by coincidence, profitability was also improved. You know, and I simply ask the point, you've got to put the right KPIs in to measure and monitor your various aspects of working progress, working capital management. And equally, you got to start eating and sleeping working capital culture within your team. And make sure everyone's aware of it. So I purposely highlight those points because I honestly have found from experience that if you share and talk about your organization's working capital and personal goals, your personal goals with the people you're sitting alongside, that actually produces good results for 2 reasons. Number one, in my experience, the more you talk about your goals, the more you become committed to them. And secondly, as you verbalize your goals to others, believe it or not, and certainly I've found this myself regularly, you gain more clarity in your own mind about what you're really trying to achieve and what you really want. So with clarity comes certainty, and with certainty comes confidence. The act of talking about your working capital goals, in our experience, is powerful and profound. So, overarching principles we're suggesting before we just bring this webinar to a conclusion. Cash is critical, but saving the business is even more important. So you've got to get your priorities right. You've got to try and shield your core ideas, your business structures, your relationships, your people, and your brand first. You've got to try and ensure that your business is agile and able to adapt quickly to change and technological advancements. You've got to recognize that now is the time for decisive, but also parallel caring leadership. You know, in terms of riding out the storm, we expect those who will ride out the current economic storm, they're going to have a strong cash management focus and decisiveness. They're going to implement a flexible operational model that can react to customer demand and ensure good communications and PR to the external market around how good the business is in terms of reacting to the ongoing COVID-19 crisis. In our own case, we're currently providing success stories, success case studies to our social media of clients who have successfully adapted and created new opportunities as a result of COVID-19. So, in conclusion, there is no doubt that the economic implications of COVID-19 for businesses operating in the Northern Ireland tourism sector are very, very challenging. But I think we all accept they do pale in comparison to the public health and human costs that we are all observing around us. Without doubt, it is very difficult to predict the future market dynamics because we are now faced with a triple COVID-19 uncertainty. Firstly, we've set ourselves around the virus itself. Secondly, around the economic uncertainty. And thirdly, how it will affect people's current and future behavior. But whatever happens, astute business leadership in terms of working capital and cash flow management will be key to business sustainability. As we have said before, our present circumstances don't determine where we go. They merely determine where we start. So to weather the current business storm, it is particularly vital, I would suggest, for businesses to adjust operational behavior and processes for working capital at pace. Yes, move with speed to stay alive. And in that context, sometimes, yes, we cannot control the events around us. But as we have often said, we do have the ability to choose how we respond. And as sure as night follows day, individuals make choices every day. Individual actions matter and can be a force for change. In that context, let's try and ensure that our current working capital and cash management strategies endeavour to try and make every moment count. Yes, there's no doubt about it. Times are currently very challenging. But what we do as business leaders is passed down within our business. Personally, in my belief, I think it all comes down to caring. 29 years ago, the first presentation I ever gave to an accountancy conference, I was allowed to choose my own theme. And I chose the theme, I don't care how much you know, until I know how much you care. And I'm more convinced now, 29 years later than ever, that that's the key to life and indeed business. So what I'm suggesting to you as we come to the conclusion of this working capital webinar is that we should lead with the heart, because compassion inspires growth. It also inspires confidence that whatever happens within our team, we will adapt and we'll overcome those challenges. Talent management. So it's also fair to say that, and not only to say it, but to appreciate that normally in the past, every crisis does present opportunities. We need to exploit and take advantage of these when the time is right. Just before moving on to the question and answer session, if today's webinar has raised any issue or question that you'd like to discuss in private, you can get in touch with us via email to industry.development@tourismni.com. And Tourism Northern Ireland will be too delighted to organise that you get an opportunity perhaps for a call with a finance expert. So I'm now looking forward to joining Patricia for participating in the question and answer session. And all that remains for me to say is to thank you very much for joining us today for the webinar, and to sincerely hope that in the days, weeks and months ahead, there will be one or two little things that we cover today that will help you with your business and create and contribute to economic prosperity in the Northern Ireland tourism sector. Thank you very much.